Hi, welcome to Main Street Macro. I'm Neela Richardson. When we tell stories about the economy, it's rarely the Cinderella economy or the Snow White economy or even the Little Mermaid economy. It's usually the Goldilocks economy that we seek. And that's because we seek an economy as a whole that is not too hot or too cold, too weak or too strong, or too fast or too slow. And so, as we head into a data week, a week full of data releases, this equilibrium balance between growing too fast, growing too slow is the state of the Goldilocks equilibrium. So, as we look forward to the week ahead, it's important to think about Goldilocks. And in this time, not the three bears, but the three cares that is in part of the Goldilocks equilibrium. Let's start out with the first care. The first care of this week is PCE inflation. It actually was released last week, but it sets the tone for all the data that's ahead. And it is the Fed's preferred measure of inflation because it's so finely tuned. It not only picks up prices in a huge array of goods and services, it also measures how consumers substitute in between these goods and services when prices rise. And the Fed, by its very mandate, is supposed to watch to make sure that price growth is neither too strong or too weak. Now, there's very little concern that price growth is too weak right now, but there is a lot of attention to how quickly prices still continue to move. And the Fed is seeking that just right rate of inflation that the economy can support. The second care of this week is the main focus of the week, which is the jobs report. And there are going to be a whole host of jobs indicators that are released this week, including the ADP National Employment Report on Wednesday. But here are the two that really stand out. The first is the unemployment rate, and the second is wage growth. As a country, as an economy, we want unemployment to stay low. We want firms to continue hiring, but we don't want them to hire so quickly for the labor market to be so tight that it spikes up wage growth again and then triggers another round of inflation. And so this Goldilocks jobs report is what the markets will be looking for, and so will the Fed. Now, the third care of this Goldilocks economy is the consumer. Remember, consumers are 70% of the economy, so we always care what the consumer is doing. And there are two data points that we're really paying attention to. One is home sales, because home sales and home prices have really driven up a lot of the inflation we've seen over the past year and a half. And so we want to make sure that the housing market is not heating up again, triggering higher price growth. And the second data point that's really worth watching this week is consumer credit. With prices higher, we want to make sure that consumers are not relying too much on debt and credit cards with interest rates at 20-year highs. So, those are the three cares of this Goldilocks economy that we seek. But the catch here is the Goldilocks equilibrium is always changing, and those cares are always shifting. But for now, Main Street is still seeking that just right economy to end this first half of the year. Thanks for watching the Main Street Macro. For more on our take on all of these indicators, please check out adpri.org.